Welcome back to the Global Ledger. I'm Justin. There's a story everywhere right now that sounds terrifying. Silver explodes higher. Banks borrow billions from the Federal Reserve, and the conclusion everyone jumps to is this is it. Paper markets are breaking, banks are panicking, silver just exposed the system. Today, we're going to slow that down a little bit. We're going to walk through the mechanics. And we're not here to dismiss silver either, but because silver does matter, but not for the reasons I think you're being told. Let's get into it. Here's the viral narrative in one sentence. Banks borrowed roughly $17 billion from the Fed because silver prices surged and paper shorts are suffocating. Logical sounding, intuitive, and it is spreading fast because I think silver jumped to $75 or $80 today. And so people are really excited about this. But the narrative of banks borrowing $17 billion from the Fed, and these things that are spreading, it's combining three completely different systems into one story. And that's where the myth begins. So let's take them apart. Okay, myth number one, Fed borrowing means panic. First, the Fed borrowing headline. Banks borrowing from the Federal Reserve does not automatically mean distress. It means one thing: banks needed short-term liquidity at a specific moment. And timing matters. December is balance sheet cleanup season, regulatory window dressing, and year-end collateral optimization. I mean, every year this is the case. Liquidity tightens by design. Using the Fed at year-end is often cheaper, cleaner, and safer than scrambling in private markets. That's not panic, that's the plumbing. And the key point here is liquidity usage is not evidence of a crisis. It's evidence of timing, in most cases. Okay, so that's myth one. Myth number two, silver is systemically important collateral. This is the biggest misunderstanding. Silver is not core collateral in the financial system. It is not repo collateral, clearing collateral, settlement collateral, margin backbone. That role belongs to treasuries. Silver can hurt traders. Treasuries hurt the system. Okay, so even a violent move in silver prices does not mechanically force banks to the Fed. There is no direct pipe from silver price to bank funding stress. That connection is imagined. It really is. It's not structural. So myth number three, paper silver shorts are about to collapse the exchange. Let's talk about paper silver. Okay, yes, there are large commercial short positions. Yes, paper claims exceed deliverable metal. No, though, that alone does not equal fraud or imminent collapse. The futures market is built on cash settlement expectations. Delivery stress only appears when large holders refuse to roll, physical sourcing fails at rising prices, an alternative supply disappears. Ratios don't cause squeezes. Behavior does. Until delivery behavior changes, paper ratios are descriptive, not explosive. But what is silver actually telling us, okay? And here's where we don't want to dismiss silver. Okay, silver's move does matter, just not in a banking apocalypse way. Okay, silver is signaling industrial demand stress, supply rigidity, time lag in mining response, or volatility in specific derivative books. Okay, silver is a commodity story, not a monetary collapse story. It's about physics and logistics, not central bank survival. So what are the stress signals, the real ones? Okay, here's what to watch, I think, instead. If the system were actually cracking, you would see it here first. Treasury repo dysfunction, failed auctions, cross-currency basis blowouts, clearinghouse margin spikes, collateral hoarding, not in silver charts. When real system stress appears, it doesn't whisper through metals. It yells, it screams through rates. So why does this myth spread so fast? Or these myths, I should say. Because it's emotionally satisfying, in my opinion. It combines distrust of banks, anger at paper markets, love of physical assets, and fear of collapse. Okay, and it collapses complexity into a single villain. But simplified stories travel faster than accurate ones. And your edge here at the Global Ledger is refusing to do that. So here's the correct framing. Okay, silver's rally may hurt certain desks, it may tighten metals liquidity, and it may force repricing over time. But it is not forcing the Fed's hand. It is not exposing a banking collapse. And it is not proof that paper markets are ending tomorrow. Silver matters. Plumbing matters more. So the danger isn't silver volatility. The danger is confusing a volatile commodity with systemic plumbing. Because when people miss real stress signals, they're always late, either too early and panicked or too late and shocked. If you want to understand money, you have to follow the pipes, not the noise. Okay, if this helped clarify the moment, subscribe or share this video or keep watching. And hopefully I can earn a subscribe from you. But I'll keep doing the hard part, which is slowing down the chaos until it makes sense. Once again, I'm Justin, and thanks for being here.